well, we've seen the balance sheet. Let's talk about the income statement, the purpose of it, why is it important, what happens on it, and what do investors and creditors want to see, right? Because in this test, it's all about the investors and the creditors, the users of the financial statements. In audit, it's about the auditors and making sure that the financial statements are presented properly for the users. In BEC, it's about running a business properly and making money. And Reg, it's about paying your fair share and calculating basis all day, every day. Now here, what's the purpose of the income statement? So remember, this zeroes out at the end of the year. So the balance at the end of the year is going to be zero for revenues, expenses, and everything that we'll see on this. Whereas the balance sheet carries forward its balances. We zero everything out and bring the net income into retained earnings, which is on the balance sheet. So it doesn't go away into nothing. It just gets transferred onto the balance sheet. That's the whole life cycle, right? It's like the life cycle, the water cycle, the respiratory system. It's a cycle, right? It's a scientific system here in accounting that someone decided to create long ago. All right, so the purpose of the income statement, we want to provide information about the income process. So expenses, income, users of funds that will never earn income, sources of funds created by expenses, and sources of funds not associated with earnings process. All right, so what are we doing with the money we make? How are we making that? Is that from customers? Is that from government contracts? What about losses, right? What about failures? We want to disclose that as well. If we embarked on a project that did not make us money, then we want to disclose that. Maybe we don't want to, but we need to, as per the GAAP and FASB and rules of that nature. What about revenues and expenses? So how do you make money? Well, you have to expend money usually. Okay, that makes sense. I mean, unless you're magic, you're growing money on a tree, but I guess you have to plant that tree at some point. Anyway, how are you making your money? What are you expending your cash on to make future revenues? And then what about sources of funds not associated with the earnings process? Well, what if you sell your equipment at a gain? That's not what you do, though. You are Apple. Let's say, Apple makes money from subscription-based revenue and selling iPhones. They don't make money from selling their equipment, but maybe they do make money from that. But we want to separate that out for information purposes and say, even though we had a big gain maybe from selling equipment, that's not normal. Don't expect to keep seeing that. That's not how we make money here. That's not how we do business. Uses the income statement, so determine the profitability. That one makes sense. The value for investment purposes. So generally, if we want to invest in something, we want to see that it's going to be profitable in the future. And then credit worthiness. Just like when you apply for a credit card, you got to give your annual income and expenses and how much you pay in rent or for your home payment. And then predict information about future cash flow based on past results, right? Amount, timing, uncertainty. Yeah, how well are we going to do? Are we a seasonal business, right? Do we make the majority of our money in the fourth quarter? Do we have any slumps? We want to have a clear picture of the company and how much we're making and how well the consistency of the funds coming in are. Some terminology on costs. So we've got a cost and unexpired cost. The cost, normal cost, is an amount actually paid for something. So if I buy a machine, if I buy a subscription service to a news outlet or merchandise received, if we pay for inventory, those are just normal costs. Whereas unexpired costs, these are costs that will expire in future periods and be charged against revenues from future periods. So this is kind of the relationship here. Well, what is the cost? And these are like journal entries, right? Because when you sell inventory, what's your expense? You debit cost of goods sold, credit inventory. Okay, well, what about when you use up your prepaid insurance, right? You prepay for 12 months of insurance. What's the journal entry? You debit expense to increase them, right? Remember that from our balance sheet lecture. And then you are going to credit your asset of prepaid insurance to reduce it. How do you account for the net book value of fixed assets? How do you depreciate them? Well, you are going to debit depreciation expense. In this case, you're going to credit accumulated depreciation. It's just a little bit of a different treatment because that's a contra account. And then lastly, what about your intangible assets? Well, you're going to debit patent expense, which is the amortization process, just like depreciation. And you are going to credit the cost of patents, the unexpired cost of patents. So this is reducing the asset of patents. So this kind of slide is just talking about the relationships between everything, how the journal entries get formed, and why they are the way they are.